Welcome back to the deep dive. Today we're going deep on Harry Browne's fail-safe investing.
Oh, a classic.
It is. We've got our notes, highlights ready to go.
Awesome.
So let's dive into his 17 rules for, see what we can find, see what nuggets of wisdom we can unearth, maybe build a more resilient investment portfolio.
Yeah, that sounds good.
I don't know about you, but I'm always looking for ways to feel more secure about, my financial future. And Brown's book seems like a great place to start.
You've hit the nail on the head. That's what Brown's approach is all about. It's about peace of mind. It's about creating that sense of calm amidst, all the chaos that's in the world of investing.
Okay, so rule #1. This one caught my eye right away.
Okay.
Brown says your career is your primary wealth building tool.
That's right.
It's kind of a bit of a reality check, right?
It is.
Reminding us that investment success really hinges on career success.
Yeah, it is. It's a really foundational principle, but one that's often overlooked.
Mhm.
Brown, he uses this brilliant analogy to illustrate it. Imagine someone with zero experience in your field, right?
Okay, yeah.
Suddenly trying to outshine you at your job.
Yeah.
It's just not going to happen. It takes years of dedication to master any profession. And investing is no different.
Yeah, that analogy really drives the point home.
It does.
So before we even think about, fancy investment strategies and all that,
Right.
we got to make sure our careers are on solid ground.
Yeah, you got to get that foundation right.
Mhm.
Absolutely. And once you have that, Brown then urges you to protect your hard-earned wealth. Rule #2 emphasizes treating it as irreplaceable. He has this chilling story about the successful entrepreneur who lost it all due to unexpected legal troubles.
Oh, wow.
It just highlights how, even those who think they've made it can still be vulnerable.
Yeah, that's a stark reminder that wealth is fragile.
It is.
And it's not just, market crashes we need to be worried about.
Right.
Kind of makes you wonder about, all the potential hidden threats to your own financial well-being, right?
Exactly. Be proactive, not reactive.
Yeah.
That's what Brown wants you to do when it comes to safeguarding your financial future.
Okay. So rule #3
Hmm.
lays out this distinction between investing and speculating. I feel like this is something I should probably already know, but Brown's explanation really, I don't know, it it really helped me solidify my understanding.
Sure.
He sees investing as a long-term game, focused on holding a diversified portfolio, whereas speculating is, it's more about those short-term bets.
It's a crucial distinction because it shapes your entire approach, your mindset, everything. Brown gives this great example of a speculator who made a killing betting on silver, but then lost it all when the market turned against him.
Oof.
It just highlights, just the volatility, just the risk associated with that approach.
Yeah. So it's not just about picking the right investments, right?
Okay.
It's about understanding your own, mindset and how you approach risk.
It's right.
Are you looking for, that slow and steady growth?
Yeah.
Or are you chasing those quick adrenaline pumping wins,
Exactly.
but knowing that you could also lose big?
Precisely. And that leads perfectly into rule #4, where Brown, he just takes on this whole world of market predictions and fortune tellers.
Yeah, those crystal ball gazers who just promise to reveal all the secrets of the market. I'm always a bit skeptical.
As you should be. Brown was too.
Yeah.
He just rejects the notion that anyone can predict the future of the market
Hmm.
with any degree of certainty.
Right.
He has this line, anything can happen, nothing has to happen.
Mm.
It's a reminder to embrace the uncertainty of the markets.
Yeah.
And build a portfolio that can weather any storm, not just the storms that we think are coming.
But isn't there a risk that that by holding, too much cash, especially when interest rates are low, you could actually lose purchasing power due to inflation?
That's true. Brown was definitely aware of that risk, but he believed that the security and the peace of mind that cash provides outweighs the potential for erosion.
So it's about that balance.
Yeah, finding that balance between protecting your capital,
Yeah.
and making sure that it keeps pace with inflation.
Okay, so moving on to rule #5, Brown, he takes aim at those so-called experts who claim they can make you rich.
Right.
Yeah, I've always been wary of those gurus who promise, those outsized returns with their secret formulas.
Yeah.
It all seems a bit too good to be true, doesn't it?
It does. And Brown shares this anecdote about a group of investors who all followed the advice of of one renowned financial expert to uh, only to see their portfolios plummet when the market, took an unexpected turn.
So even if an expert has, a stellar track record,
Yeah.
it's no guarantee of future success.
Past performance is not indicative of future results.
Right, right. So, what's Brown's take on all those fancy trading systems that claim to have, cracked the code of the market?
Well, he's just as skeptical of those as he is of market predictions. In Rule #6, he really dismantles the allure of trading systems. He calls them a fool's gold.
I gotta admit, those back-tested results showing, all those hypothetical profits you could have made.
Right.
It's tempting.
It's incredibly seductive. But Brown reminds us that historical patterns are not guarantees of future performance. The market is constantly evolving, and what worked in the past might not work in the future.
So even if a trading system has a seemingly flawless track record, it's still no guarantee of future success.
You got it.
So this leads us to I guess a cornerstone of Brown's philosophy, the power of cash.
Yes.
Rule #7.
That's right.
Might seem a bit counterintuitive in today's world of, readily available credit, but Brown was adamant about investing only on a cash basis.
Absolutely, he was.
He tells that story of a billionaire who went broke by over-leveraging his investments, right?
He does. It's a cautionary tale highlighting the dangers of borrowing to, magnify your potential profits. While leverage can amplify gains, it also magnifies losses, potentially leading to, financial ruin.
So it's about, avoiding that temptation to take on that excessive risk.
Yeah.
Even if it means, potentially missing out on some gains.
It's about building your wealth on that solid, debt-free foundation, making sure you're not, putting your financial security at risk by chasing those returns that might not materialize.
This next rule really resonates with me.
Okay.
Rule #8, all about taking control and making your own investment decisions.
Yes. Self-reliance.
So you need to understand the basics of investing, right?
Yeah.
And just take ownership of your financial decisions.
Absolutely. Brown believed that, that you should never relinquish control of your investments to anyone, no matter how impressive their credentials might be.
So it's about educating yourself, asking those right questions.
That's right.
Not being afraid to challenge the advice of so-called experts.
You got it. And that leads us to the core principles underpinning Brown's signature creation, the permanent portfolio.
But before we dive into that, I'm curious about the importance he places on understanding your investments and spreading the risk. Rules #9 and #10.
Yeah, those are crucial foundational concepts. Brown believed that you should never invest in anything you don't fully understand, no matter how tempting the potential returns might seem.
Yeah, that's good advice for life in general, I'd say.
It is. And when it comes to spreading risk, Brown's message is clear. Don't put all your eggs in one basket. Diversify. Diversify your investments across different asset classes. Reduce your vulnerability to any single event.
So, understanding diversification kind of sets the stage for Brown's his permanent portfolio.
It does.
Which he says you can set up in a single day.
He does.
Now, what's the big idea behind this permanent portfolio?
Yeah.
What makes it so permanent?
Well, Brown's permanent portfolio is designed to weather any economic storm. And he identified 4 key economic environments. Prosperity, inflation, tight money, which is basically a recession, and deflation.
So he's thinking about all those possible scenarios that could impact the economy.
That's right.
And by extension, your investment.
And your investments. He believes that to be truly fail-safe, your portfolio needs to be able to thrive in any of those environments.
So how does he translate those economic environments into a specific investment strategy? What are the building blocks of this permanent portfolio?
So the 4 investments are stocks, bonds, gold, and cash.
Okay, that's a pretty diverse mix. Sounds like he's covering all his bases. But how does he decide, which investment goes with which economic environment?
Well, he starts with prosperity. Those periods of economic growth.
Yeah.
Living standards are rising. Brown argues that stocks tend to do well in this environment.
That makes sense. When businesses are thriving, their stock prices usually reflect that.
Exactly. And he also points out that as prosperity drives interest rates down, long-term bonds tend to increase in value as well.
Okay, so stocks and bonds for prosperity.
Yeah.
What about inflation?
Yeah.
What's the go-to investment there?
For inflation, Brown believes gold is the ultimate hedge. As inflation erodes the purchasing power of the dollar, investors often flock to gold as a safe haven,
Okay.
driving up its price.
So gold acts as that store of value
Exactly.
during those uncertain times.
Yeah.
But what about deflation? We don't hear that word thrown around too often these days.
No, we don't. But Brown felt it was important to consider. Deflation is basically the opposite of inflation. Falling prices. He believed that during periods of deflation, U.S. Treasury bonds would perform well as interest rates plummet.
Interesting.
Yeah.
So bonds are the star in both prosperity and deflation.
That's right.
That leaves us with tight money, which Brown also calls a recession. What's the best way to navigate those turbulent times?
Cash.
Cash.
Yeah. I know it might seem a little counterintuitive.
Yeah.
But hear me out.
I'm all ears. Why would you want to hold cash when the market is potentially tanking?
Well, Brown's argument is that during recessions, cash provides that much needed liquidity and flexibility. It allows you to seize those opportunities to buy assets at potentially discounted prices.
Okay.
While others are panicking.
So cash isn't just about playing defense. It's about positioning yourself for a comeback.
Exactly.
When the market eventually recovers.
When the market recovers. It's about preserving your capital and having the flexibility to act decisively when opportunities arise.
Okay. So we've got our four economic environments and our four key investments. How does how does Brown tie it all together into this permanent portfolio? What are the specific allocations that he recommends?
He recommends dividing your capital equally among the four investments, allocating 25% to each. So your portfolio would consist of 25% stocks, 25% bonds, 25% gold, and 25% cash.
Okay, that's remarkably simple. I have to admit, part of me was expecting something much more complex, much more convoluted.
I think that's the point. Brown was a firm believer in simplicity. He felt that complexity often obscures risk. Creates unnecessary confusion.
So you're not trying to time the market. You're not trying to, to pick winners with this strategy.
Not at all.
You're simply spreading your bets across different asset classes that are designed to perform well in those different economic environments.
You got it. It's a set it and forget it approach to investing. Brown argues that by holding this balanced portfolio, you're protected against any economic storm, regardless of what the future holds.
It sounds good in theory, but how has this permanent portfolio actually performed?
Right.
Does it live up to the hype?
Well, according to the data Brown presents, the permanent portfolio has a pretty impressive track record. From 1970 to 1998, this portfolio generated an average annual return of 9.9%, beating inflation by 4.5% per year.
That's a significant outperformance, and I imagine that that period included a wide range of economic conditions.
It did.
Right.
Absolutely. It encompassed periods of high inflation in the 70s, a roaring bull market in the 80s and 90s, several recessions throughout those decades.
So it seems to have held up well through various market cycles.
It has.
Brown also talks about the portfolio's performance during the 1987 stock market crash.
He does.
That's
It's a striking example of the portfolio's resilience.
Yeah.
On Black Monday, when the Dow Jones Industrial Average plummeted by a record 22.6%.
Oh, wow.
The permanent portfolio only lost 4.3%.
Wow, that's impressive.
It is.
That really highlights the power of diversification, right?
Yeah.
While stocks were taking a beating, the other assets in the portfolio, particularly gold, acted as a buffer.
Exactly.
And despite that crash, the permanent portfolio still finished 1987 with a gain of 5.3%.
That's right.
So it seems like this permanent portfolio might actually live up to its name.
Yeah.
It's a diversified, balanced, historically resilient approach to investing that aims to provide that long-term security,
Yeah.
no matter what economic storms might be brewing on the horizon.
That's the idea. And while past performance is never a guarantee of future results, the track record certainly suggests it's a robust strategy.
Now, I know we've been talking a lot about this permanent portfolio,
Right.
but what about those of us who are looking for more excitement
Yeah.
in our investments? What does Brown say about speculation?
Well, that's a great question because Brown understood that the desire to seek outsized returns. It's a powerful motivator for a lot of investors. So he doesn't completely shut down the idea of speculation.
So he's not advocating reckless gambling with your life savings.
No, not at all. He proposes a framework for incorporating speculation into your overall investment strategy, but with a very specific set of rules
Okay.
to protect yourself from those inherent risks.
I like this idea. It's like having, two separate investment accounts.
Yeah.
One for, safety, long-term security,
Right.
that permanent portfolio.
Yeah.
And then one for taking those, calculated risks
Oh, yeah.
and chasing those potentially higher returns.
You got it. He calls the second account the variable portfolio,
Okay.
specifically for speculative investments.
Okay, so let's dive into this variable portfolio. What's Brown's golden rule when it comes to speculating?
Only use money you can afford to lose. This means that any funds you allocate to the variable portfolio, they shouldn't be essential to your long-term financial security.
So if things go south,
Yeah,
it's not gonna derail your retirement plans. It's not gonna impact your ability to meet your financial obligations.
exactly. It's about drawing that clear line between your safe money
Okay.
and your play money.
So this approach seems like a good way to acknowledge that psychological pull towards speculation, but
Yeah.
without jeopardizing your financial foundation.
Precisely. That's exactly Brown's point. He understood that trying to completely suppress the urge to speculate, it can backfire, leading to even riskier behavior. The variable portfolio is like a pressure valve, allowing you to explore those riskier ventures without putting your core financial security in jeopardy.
It makes sense. Now, does Brown offer any specific guidance on how to manage this variable portfolio?
He doesn't lay out strict rules like he did for the permanent portfolio.
Sure.
He recognized that speculation is a highly individualized activity, driven by personal preferences and investment philosophies.
So this variable portfolio is more of a free for all, where you can experiment, you can test out different strategies,
Yeah.
and chase those potentially higher returns, but always with money that you can afford to lose.
Exactly. It's a sandbox for testing your investment theories,
Mhm.
exploring different approaches. However, he did offer some general wisdom for navigating this more speculative realm.
Okay, I'm all ears. What were some of his key insights into the art of speculation?
He emphasized the importance of understanding that speculation is inherently risky.
Yeah,
Losses are inevitable,
right.
and you shouldn't shy away from that.
It's not about avoiding those losses altogether.
Yeah.
It's about managing those losses and preventing them from derailing your overall financial plan.
You nailed it. He also stressed the importance of having a clear exit strategy, both for locking in profits and limiting losses.
Yeah, having an exit strategy is crucial for any investment, but especially when it comes to speculation.
It is.
It helps you stay disciplined,
Right.
make rational decisions,
Yeah.
even when emotions are running high.
Absolutely. Brown also cautioned against blindly following the crowd or chasing hot tips. He believed that successful speculation often requires thinking independently and identifying those opportunities that others might have missed.
So it's about doing your own research, trusting your gut,
Yeah.
having that courage to bet against the consensus when you see a compelling opportunity. That takes a certain level of confidence and conviction.
It does, but it's important to remember that speculation is a high risk, high reward game.
Mm.
The potential for losses is just as real as the potential for gains. Brown's message is crystal clear. Don't speculate with money you can't afford to lose.
Now, even with a carefully crafted investment strategy, aren't there some risks that are simply beyond our control?
You're absolutely right. Brown, despite his focus on building a fail-safe system, he acknowledged that some events, they could just disrupt even the most well thought out plans.
So he wasn't claiming to have, all the answers or magic formula
Right.
for guaranteed success in all circumstances.
He understood that life, and especially investing, is full of uncertainty, and that's one of the most valuable takeaways, I think, from his work. It's just a reminder to approach investing with humility.
Yeah.
Acknowledge that we can't predict the future,
Right.
and build a portfolio that can adapt to a wide range of potential outcomes.
It's about accepting that while we can't control everything, we can control how we prepare for the unknown.
Precisely. Brown's permanent portfolio, with its emphasis on diversification, balance, and long-term resilience, it really embodies this philosophy. It's a strategy designed to navigate the inherent uncertainties of the financial markets,
Yeah.
offering a sense of security amidst the unpredictable nature of life.
Yeah, I like how he manages to find that balance between pragmatism and optimism.
He does.
He clearly advocates for a simple, low maintenance approach to investing. But he also understands that that sometimes investors need a little extra help.
They do.
He doesn't completely dismiss the value of professional guidance.
He doesn't. He recognized that that seeking professional advice can be beneficial, especially when you're dealing with those complex financial matters.
Yeah.
Or when you simply lack the time or the expertise to manage your own investments.
So it sounds like he's not entirely, anti-advisor.
Right.
Just anti-blindly trusting those who claim to have all the answers,
Yeah.
or a crystal ball
Right.
that predicts the future of the market.
He believed that advisors could be valuable helpers. They could provide information, guidance, and facilitate the execution of your investment plan. But he was wary of those who position themselves as market beaters,
Right.
promising to deliver those outsized returns through their superior skill or insights.
So it's about finding an advisor who understands your goals,
Yeah.
who aligns with your investment philosophy,
Yeah.
and acts as a trusted guide rather than a fortune teller.
That's right.
It also seems like Brown places a lot of emphasis on understanding the fees and incentives that drive the financial industry.
Absolutely. He stressed the importance of being aware of the fees you're paying for investments and advisory services. Those fees can quietly chip away at your returns over time. So it's crucial to choose investments and advisors that are transparent and cost effective.
Now, before we wrap up this part of our deep dive,
Right.
we need to revisit one last piece of the puzzle.
Okay.
The variable portfolio.
Yes.
It's that it's the more speculative, adventurous side of Brown's investment strategy.
You got it. And it's where things can get really exciting.
Yeah.
Remember, this is the portion of your portfolio dedicated to those higher risk, potentially higher reward investments.
Right.
It's the playground.
Yeah.
Where you can test your theories and chase those moonshot opportunities.
But always with money you can afford to lose.
Yeah.
That's Brown's golden rule of speculation.
Absolutely. He emphasizes that the variable portfolio should be treated as a distinct entity from the permanent portfolio.
Okay.
A separate account where you can take those calculated risks without jeopardizing your long-term financial security.
Okay. So let's say I've set up my permanent portfolio, right,
Yeah.
for safety and stability.
Yeah.
And now I'm ready to, dip my toes into the waters
Yeah.
of speculation with
Yeah.
the variable portfolio. What does Brown suggest I invest in?
Well, that's where it gets really interesting and also a bit more challenging. Browne doesn't lay out specific investment recommendations, uh, for the variable portfolio because he understood that speculation is a highly individualized activity.
So it's more about providing that framework
Yeah.
for responsible speculation
Yeah.
than dictating specific investments.
Exactly. He wants you to, to explore different strategies, test your theories, chase those potential moonshot investments, but always with a clear understanding of the risks involved.
Because the variable portfolios is where you can indulge your inner risk taker,
Yeah.
but with a safety net
Exactly.
provided by the permanent portfolio.
Exactly. It's a way to balance the need for security with the desire for those potentially outsized returns.
Hmm.
It's about embracing
Yeah.
the full spectrum of investing, from the cautious and steady to the bold and adventurous.
Yeah, it sounds like Brown has a lot of trust in the individual investor's ability to make informed decisions, even in the realm of speculation.
He does, but he also provides that framework for making those decisions responsibly,
Hmm.
always emphasizing the importance of, of understanding the risks
Hmm.
involved and only using the money you can afford to lose.
Right, right. All right, that covers a lot of ground. We've explored the ins and outs of both the permanent portfolio
Yeah.
and the variable portfolio.
Right.
We've talked about financial advisors, and the fees they charge.
That's right.
I feel like we're starting to get a good grasp of Brown's overall approach to investing.
I agree. But before we move on, there's one potential critique of Browne's approach that I think we should address.
Okay.
Um, some might argue that his insistence on equal allocations
Yep.
to all four asset classes in the permanent portfolio, regardless of market conditions, is too rigid,
Okay.
and it might cause investors to miss out on opportunities.
So they might argue that that you could potentially achieve higher returns by adjusting your allocations, based on perceived market trends.
Exactly, but Browne firmly believed that no one, not even the most seasoned investor, can consistently predict the future of the markets.
Yeah.
He felt that trying to time the market or chase trends is often driven by emotion
Right.
and can lead to to costly mistakes.
So his advice is to stick to the plan, rebalance regularly,
Yeah.
and just let the diversified nature of the permanent portfolio work its magic over time.
Right.
Even if it means potentially missing out on some short-term gains.
That's the essence of his philosophy: discipline, patience, recognizing that the permanent portfolio is designed to perform well over the long haul, not necessarily to win every single year.
Now, Brown, he clearly advocates for, this simple low maintenance approach to investing.
Yeah.
But he also delves into the practical aspects of managing the permanent portfolio.
He does.
Yeah.
Very specific guidance on how to actually implement the strategy.
So he doesn't just leave you hanging with a theoretical framework, right?
Right.
He actually walks you through the nuts and bolts of setting up and managing the permanent portfolio.
He does, even outlines the specific types of investments you should use for each of the four asset classes.
Okay, let's start with stocks.
Yeah.
What does he recommend there?
For the stock portion of the permanent portfolio, Browne suggests using a mix of mutual funds that invest in a broad cross section of the market.
So he's not he's not advocating for picking individual stocks or trying to time the market, which is a relief.
No. He believed that for the permanent portfolio to be truly fail-safe, it needed to be simple and low maintenance.
Okay.
And using broad market index funds or diversified mutual funds aligns perfectly with that philosophy.
Okay. So for stocks, it's about it's about capturing the overall growth of the market,
Right.
not about trying to outperform by picking winners and losers. What about bonds?
For bonds, Browne recommends using U.S. Treasury bonds.
Oh, those are considered the gold standard of safety in the bond world.
They are. They're backed by the full faith and credit of the United States government, which makes them highly unlikely to default. They're considered one of the safest investments that you can make.
So once again, the emphasis is on safety and stability.
That's right.
He wants you to, to rest assured that your investments are secure.
Absolutely. Now, moving on to gold,
Mm.
how do you think he suggests incorporating that into the permanent portfolio?
Let me think. Since he's all about simplicity and
Yes.
minimizing fees, I would guess he'd recommend a gold ETF.
Actually, Brown believed that the best way to hold gold is in the form of physical gold coins.
Really? So we're talking about actual gold coins,
Yeah.
the kind you can hold in your hand.
Exactly. He felt that owning physical gold was the most direct and reliable way to gain exposure to its price movements.
I can see the appeal of having that tangible asset,
Yeah.
something you can physically hold in control. But where would you store these gold coins under your mattress?
He recommended storing them in a safe deposit box at a bank for security and convenience.
Okay, so we've covered stocks, bonds, and gold. That leaves us with the cash portion of the permanent portfolio. What's Brown's preferred approach for that?
He recommended using a money market fund that invests only in short-term U.S. Treasury securities.
Okay. Why those specific securities? Is it about minimizing risk even within the cash portion
Sure.
of the portfolio?
Short-term U.S. Treasury securities, like Treasury bills,
Right.
they're considered extremely safe because they're backed by the U.S. government
Hmm.
and have very short maturities. This minimizes the risk of the price fluctuations that can occur with longer term bonds.
So it's about finding a way to hold cash, that preserves its value, generates a modest return,
Right.
while minimizing risk, even in that seemingly safe asset class.
Precisely. Brown also he liked that money market funds offer
What he
convenience and
spent?
diversification
Hmm.
within that cash allocation.
Okay, so now we have a clear picture, I think, of how the permanent portfolio is structured
Yeah.
with its equal allocations to stocks, bonds, gold, and cash,
That's right.
and the specific types of investments to use for each.
Yeah.
But I'm wondering, how often does Brown suggest rebalancing the portfolio
Yeah.
to maintain those equal allocations?
Brown he believed in keeping things simple and recommended rebalancing only once a year, typically at the end of the year.
Then what does rebalancing involve?
Rebalancing simply means adjusting the allocations of each asset class to get back to that original 25% target.
Oh, okay.
So, for example, if stocks have had a fantastic year and their allocation is grown to 30%
Yeah.
of the portfolio, you would sell some stocks and use the proceeds to buy more of the assets that might be lagging behind, like bonds, gold, or cash.
Okay, and the reverse is also true.
That's right.
If one asset class has taken a hit and its allocation has dropped to, say 20%, you would buy more of that asset class to bring it back up to 25%.
Exactly.
Okay, that seems straightforward enough. But I have to admit I'm a little curious about Brown's thoughts on taxes. They can have a significant impact on investment returns. So I'd love to hear how he addresses that.
You're right. Taxes are a crucial consideration.
Mhm.
Brown understood that they can erode your investment returns over time,
Mhm.
and he was a big advocate for taking advantage of tax reduction plans.
So he's not talking about, any shady tax evasion schemes,
No, no, no.
but rather, legitimate strategies to minimize your tax liability.
Legitimate strategies.
Right.
Absolutely. He emphasized the power of tax deferral, allowing your investments to grow and compound without being taxed until you withdraw the funds, typically in retirement.
Yeah, and those tax deferred gains can really add up over time.
Absolutely.
Yeah.
Brown believed that utilizing, tax-advantaged retirement accounts like 401ks and IRAs can significantly enhance your long-term returns.
So it's not just about, picking the right investments and managing risk.
Right.
It's also about, about optimizing your tax strategy
That's
to
right.
maximize those returns over the long run.
You got it. Now, before we wrap up this part of our, deep dive, there's one more rule of Brown's that I think is worth highlighting.
Okay.
It's rule #15,
Okay.
and it's all about asking the right questions.
The art of asking the right questions. That's a skill that that can be applied to so many areas of life, not just investing. I'm eager to hear how Brown applies it to the world of finance.
Well, Brown believed that asking the right questions is essential for avoiding those common investment pitfalls
Right.
and making informed decisions.
Yeah.
He cautions against getting caught up in the hype of past performance, blindly following the crowd, seeking out insider information.
So it's about it's about cutting through the noise and focusing on what truly matters.
Exactly. For example, instead of asking how well did this investment perform in recent years, Brown suggests asking what kind of economic climate would cause this investment to thrive, and do I believe we're heading into that kind of economic climate?
That's a much more thoughtful and strategic approach. I think it's about understanding the underlying drivers of an investment's success, not just chasing past performance.
Exactly.
Yeah.
And he also cautions against asking how much you should invest in something. He believed that that's a question only you can answer,
Right.
as it depends on your individual circumstances, your risk tolerance, and your financial goals.
So it's about taking ownership of your investment decisions, right?
Yeah.
Doing your own research and not blindly following someone else's recommendations.
That's right.
It's about understanding the why behind your investments, not just the what.
You've got it. And that leads us to a rule that might seem a bit counterintuitive for those laser focused on maximizing returns.
Yeah.
Rule #16 is all about enjoying your wealth along the way.
Yeah, that's an important reminder.
It is.
It's easy to get so caught up in building wealth for the future, that we forget to enjoy the present moment.
It is. Bram, he believed that it's essential to to budget for pleasure, to savor the fruits of your labor, while you're still working toward your financial goals. He even suggests setting aside a specific amount each year that you can guiltlessly spend on things that bring you joy.
I love that. It's like giving yourself permission to live a fulfilling life, right?
Yeah.
Without that like constant worry of derailing your long-term financial plans.
Yeah.
It's about finding that sweet spot between, financial prudence and enjoying, life's simple pleasures.
Exactly. And that brings us to Brown's final rule.
Okay.
A rule that I think beautifully encapsulates his entire philosophy of fail-safe investing. Rule #17 states, when in doubt, err on the side of safety.
That's a powerful principle.
It is.
It speaks to the importance of prudence, caution,
Right.
especially when you're dealing with something as vital as your financial well-being.
Absolutely. Brown, he understood that the world is full of uncertainty.
Right.
And he believed that the best way to navigate that uncertainty is to prioritize safety over potential gains.
So he's not saying don't take risks. He's
Right.
saying don't take unnecessary risks.
Right.
Especially when you're dealing with money that's crucial to your financial security.
You got it. He encourages us to approach investing with a healthy dose of skepticism.
Yeah.
To question those assumptions,
Right.
and to be wary of anything that seems too good to be true.
Yeah.
And he reminds us that it's okay to miss out on on opportunities.
Yeah.
It's far better to, to miss out on a potential gain
Mm.
than to suffer a devastating loss.
Yeah.
Especially when it comes to the money you're relying on for your future.
Yeah, that's a perspective we could all benefit from. Brown's permanent portfolio with its emphasis on diversification, balance and long-term resilience
Right.
is a testament, I think, to that philosophy.
It is.
It's a strategy designed to weather those unpredictable storms of the financial markets,
Yeah.
offering a sense of security
Right.
amidst the inherent uncertainty of life.
Well said. And I think that brings us to a natural transition point.
Okay.
We've covered a lot of ground in this segment. We've delved into the specifics of both the permanent portfolio and the variable portfolio, discussed the role of financial advisors, and touched on Brown's emphasis on asking the right questions and enjoying your wealth along the way. But before we wrap up this episode,
Yeah.
I'd like to leave you with one final thought from Brown, a thought that really encapsulates, I think, his entire approach to investing and perhaps to life itself.
Okay, I'm all ears.
He said, too many people spend their lives striving to reach a goal they'd instantly reject if they knew they'd be stuck with it forever.
That's thought-provoking, isn't it?
Well,
Makes you wonder, are we chasing the right goal?
right. Are we building a life we actually want to live, or are we just blindly following a path that we think we're, supposed to follow?
So much of Brown's work, I think, boils down to just, taking control of your finances, taking control of your life.
It's about defining what success means to you,
Mhm.
not letting society or anyone else dictate your path.
And I think his fail-safe investing philosophy is really just one piece of that larger puzzle.
I think you're right. It's about creating a life of freedom and security, where money is a tool that you use to achieve your goals.
Yeah.
Not something that controls you.
Well said. Well, on that note, I think it's time to wrap up this deep dive into fail-safe investing.
Okay.
Hopefully, our listeners have gleaned, some valuable insights from Harry Browne's wisdom,
Sure.
and are feeling a little bit more confident about navigating the often turbulent waters of the financial markets. Until next time, stay curious.